Working? Yeah, that's good. We've run out of lapel mics, so that's why I've got this, but it sort of helps me feel a little bit more like an interviewer for the session that I'm going to wrap up today. It's been a really enjoyable conference, and hopefully this is going to be an interesting chat as we just sort of look back over the last wee while. If I can just introduce everybody from the far end there, I probably don't need a great deal of introduction. Jackie Johnson, Chief Executive of IAG. I won't go through the biography. I think that's pretty much unnecessary. But obviously, IAG, our largest insurer in New Zealand. And so what we have on the panel here is a combination of very different levels of scale and longevity in the market. And what we're looking to explore here are the kind of different perspectives that come through from each one of them, depending on their market, their audience, their size, their scale, and how long they've been in the market. So John Lyon, Managing Director of Ando, underwriting agency for Hullard, soon to get license. John, of course, formerly known as the Chief Executive of Lumley, coming back into an underwriting agency role, clearly dealing through an intermediated space, and obviously starting off small, but with a significant backer behind in Hollard. Dani Mathi from Youi, Managing Director Australia and New Zealand for Youi. Youi came into the market, I think, about 14, 15 months ago. Obviously direct in that domestic space, and has made a big impression in the market with a whole lot of pretty high-profile advertising and marketing. And finally, Chris Curtin, who is the Chief Executive of AA Insurance, another direct, but one that's been well established here. Chris, I think you've been Chief Executive of AA Insurance here for 17, 18 years or something like that?
20 years.
20 years?
Someone
okay.
suggested I'm the oldest.
No, that can't be right. Okay, so that's the combination that we've got. We've got direct, we've got intermediated, we've got longevity, and different levels of scale as well. I just want to start this off by asking the new entrants, what was the attraction to come into a New Zealand market? And from the customer's perspective, what is the proposition really that is going to be the benefit? So whichever one wants to pick it up, John or Dani, over to you.
Happy to go, John?
Yeah, I'm happy to go. Yeah, I suppose there are many attractions from my point of view. We've heard a lot today about a whole bunch of emerging trends in the market. That sounds a bit scary.
Bit ominous, doesn't it?
Spaceship insurance, that could work. No, we saw all these trends happening, ranging from the data to technology, to consumer behaviors, to employee expectations. And our view was that creating a business that was unencumbered by legacy issues such as IT, culture, earthquake, in a market that is heavily consolidated with a large number of changes to distribution relationships with new players coming in, like Steadfast and Austbrokers. There was sufficient market turmoil there to create an organization that was very strong, will be very strong on agility, with great people and great technology that will be able to adapt to the environment quicker and with more agility than some of the more established players who've got some of that legacy sort of containment. So
okay.
that was pretty much the main reason behind it.
Okay, and Dani?
Yeah, I would have to agree with much of what John has said, specifically around the consolidation. New Zealand's one of the most concentrated markets in the world, probably, and from a consumer's perspective, not having the option of choice, we think it's a compelling value proposition to say, well, there's a new entrant. There hasn't been a new entrant really in the New Zealand space for many a year. And as a startup business, again, we don't bring any of the legacy systems or problems. We can be reasonably dynamic in responses to consumer requirements. So pretty much the same view on that, yeah.
Okay, now coming to Jackie and Chris, I mean, hearing those comments, it sounds like scale and capacity to invest in technology are capabilities that both your organisation should be able to bring either through the Suncorp Group or IAG, and yet the counter is essentially less agile and encumbered by legacy systems. Response to that?
Yeah, do you want to go? I'll go first. So I think it's quite an interesting topic because within IAG, I did our startup back in 2006, and actually we launched at the same time you in Australia launched, particularly around the same month, I think. And so it was all about learning what a new company would be like and how you'd disrupt yourself. And the buzz was never so much about learning to, it gave us a different customer proposition, but it was about how you'd understand disruption. And that's given us quite an interesting perspective as IAG, because what we've realised is you can have your incumbent brands that customers really gravitate to and respect and like, and you have to be very careful doing anything with those, but you can actually have different propositions. And I think the challenge for any large company anywhere in the world in any sector is how you don't have the Kodak moment. We all hear about that. And so the real challenge for any incumbent in any market is how do you make sure you're thinking exponentially about protecting your customers who love you for who you are, and particularly the iconic brands. And it's not so much just about your technology. I mean, people get very wedded to your brands. And also, how do you then keep innovative enough? So for us, at a group level, we're looking at how do we flex, and I think we've moved more in the last year in New Zealand and in Australia than I've seen us move I joined IAG in 2001. Because we've unhooked some things off our traditional processes. So I think the first thing is not to assume that if you're the incumbent that you can't be agile, because it's about understanding. And I love some of the speakers today talking about skills, and I tell my team, I was reading a book and they were saying skills are only relevant now for 3 years at a time. And someone said to me, and I apologise for all the actuaries in the room, someone said to me, the actuaries are really stuffed, aren't they? Because it takes them 7 years to become an actuary. But I think in the times I graduated, your skills would be relevant for about 20 years. Now I probably couldn't splint as an occupational therapist anymore. But, I think that's one of the challenges that we've got is our mindset thinks new entrants, small, is innovative and can move, and an incumbent can't. What I will say is markets consolidate, any markets consolidate and then grow, new entrants come. I mean, we had new entrants in our market just before the earthquake had hit. And, it only takes something to look structurally at what can change in a market. I have a lot of respect for new entrants because I think it keeps us on our toes.
And Chris?
Yeah, I agree with Jackie. It's kind of interesting being called an established brand, and I think if you look at AA Insurance, we were probably, before, from a direct personal lines point of view, the last new entrant in this country, which was 21 years ago. And so the question I ask is, number one, why are new entrants attracted? And I think from our perspective, we would always ask the question, what is it that the existing incumbents aren't offering to consumers that make it attractive to a new entrant to come in? Consolidation, business opportunity, yes, but from a consumer point of view, what is it that we are not doing as incumbents that consumers find of value? And I agree with Jackie about, I don't think just because you're an established player that theoretically has some legacy incumbencies, if you have a simple and focused business model and you have the customer at the centre of your thinking, then you ought to be able to be nimble and agile as well as be able to benefit from those scale opportunities that you get by being part of a group like, say, Suncorp or IAG.
One of the challenges that's been thrown up today, sorry John, were you going to...
Yeah, I just wanted to reinforce that point. I don't associate agility with being small. There are some really big companies that are incredibly agile, Apple, Air New Zealand, And agility is about strong process, it's about culture. It's as much about culture as it is about anything else. It's about leadership. So I think that's one myth that needs to be dispelled. There are small companies that aren't agile. So, and you can compare a centralized company with a decentralized one, a specialist against a generalist, a new versus an incumbent, big versus small. You can have New Zealand owned versus offshore. Each has its advantages. Each has got its strengths. Big brands are powerful. There's a lot of R&D. There's money to invest. There's long-term views can be taken by big companies. Small companies run on the we're running on the smell of an oily rag. So we don't have that investment. But it's all about using what you've got, playing to your strengths, and looking to deliver value to customers from that position, knowing what you're good at, knowing what you're not good at, and playing within that world. If you're big, you use your scale to your advantage.
Yeah. So I mean, it's great. The discussion's landed us in the spot of the customer right from the start, which is a good spot to be for a conference like this. So the question, one of the challenges that came up today was around, the customer likes, and the generation today wants to go online, choose a price, and then we've got this challenge around what is the cover, what is the product that's actually being purchased. I guess, if we are agile, if we are being innovative, if we are being smart, then how do we tackle that fundamental problem of trying to get the customer to understand that it's not all about price, there's something more there. And it's not just a financial long-term capability issue, it's one of, is there the technology there that helps us be smarter about that and getting that communication through? Anybody's choice.
I mean, I think one of the frustrating things, and I was really pleased to hear Samson's presentation, because when we talk about digital, and why I think the aggregator model can be, it's a complex debate, because you assume that being digital means you sell and maybe lodge claims online and do your renewal. Being digital and thinking of digital natives, we have to get the message on how we engage digitally, and that's through so many channels like Samson brought out in his presentation. And I think ICNZ, we're signatories to the UN Sustainable Insurance Practice. So we really need to think about how we're signalling the responsibility of people to look at risk. And so that's a complex thing for us to do digitally. How do we engage? And it's why we spent a lot of money on our Need to Know campaign, because it was about, if you're trying to signal the risk conversation rather than let's flog a product. And I love someone said this morning about, does a customer buy or do we sell? And I think that's a very important debate for us to all think about. How we understanding how we engage, not whether people are buying or selling, but we're actually having a conversation and an engaging experience with our customers.
I think the discussion today about sum insured's been very interesting, because it came up 3 times. I think Mr. Brownlee mentioned it, David Cagle mentioned it, and I think Sue Chetwin mentioned it. And I think, this is all in and around education of customers. I think AA Insurance got quoted this morning in some research where there was, I think it was 75% of people that we researched were customers of ours hadn't adjusted their sum insured. I can tell you this, just to let you know, in terms of claims, I think we've had 0% of people that had a problem with underinsurance. But the issue is, and it goes to the heart of selling our products for the value and the cover that it provides rather than price. If we can't get the sum insured part right, then I don't think we can put our heads in the sand and say we just ignore it. We'd have to do something more about it. I'm not sure what the answer is, but certainly we need to be engaging with our customers in a different way using digital technology that addresses these issues, because we can't just sit here and ignore them.
Just a quick comment. I think in Professor Manning's presentation, I tend to agree with him. I think the aggregator model is a difficult one. It's going to bring a strong focus to price. Unfortunately, that's the driver for the consumer at that point in time, and without a good conversation between someone who's educated and trained in a specific product, it's going to be very difficult for them to fully appreciate what they're purchasing and what the risks are and what cover exists. It's been shown before in the world, and I don't see how it's going to be much different going forward.
Because I was just going to add a comment there. So Dana, you're looking at defined risks in terms of your offering versus an all risks policy. Talk us through that. Is that a reflection of getting through to the customer, or what's the story?
Yeah, well, I just think it's a different approach. It's an insured perils approach, and it's a bit about tailor-making the product. I mean, clearly all the key factors, theft, fire, etc., are covered, but certain things, customers don't need to pay for. They need to decide whether they want them. We need to guide them through that decision by presenting them clearly what's on offer, what's optional, what's included, and what's available. So by doing that, by asking more questions, by understanding the risk better, we can price more accurately, and we can tailor-make a policy better suited to what a consumer wants.
John, I was just cut you off there.
Yeah, no, thanks, Tim. I think the product side of it, I'm not so sure that there are major issues with the product. We're going through a post-event recalibration now of product, and it'll eventually settle where it settles. I think the biggest issue is what was shown in Bob Jones's slide earlier this morning. 57% of money that's paid in insurance premiums goes back to the customer as claims, which means that 43% of it goes somewhere else. And again, that's one of the reasons why we're starting the business we're starting, is to try and make that whole value chain more efficient, inserting ourselves in there to try and help those around us to cut out costs, whether it's using technology or digital or good process or more streamlined, whatever it might be. But that to me is where insurance needs to go to demonstrate more value, is if we're giving back 85% of the insurance premiums in claims, as some health insurers do, or at 90%, then you start getting to the point of actually people realizing, well, actually they're going to get paid out more claims, or they're going to pay less in premium, therefore the value equation is better. And I think that's where the emphasis needs to go. And I think there's a real opportunity to do things a lot smarter there.
Yeah, another of the themes that came up today was foreshadowing structural change in the industry. I can't remember who it was who was talking about Munich Re and Swiss Re, a certain percentage right in the direct market. We have associations with Berkshire Hathaway and the IAG group. So looking ahead and looking at the kind of structural change that we're starting to see, where do you see this maturing to, if there is a maturity, or is it just a constant change? And what are the implications perhaps for the end consumer of the kind of changes that we're seeing?
I think my personal view is I think we have to unlock ourselves from the cycle conversations we constantly have, as if it's some magical thing that in the insurance industry we have really what is supply and demand, but we call it the insurance clock, because all it is about supply and demand of capital. And I think what we're hearing throughout today, and Bob's paper brought this to life, capital is at the cheapest it's probably ever been. So you're getting alternative instruments coming into our sector, and then it's also impacting, if you're listed, you've got different investors with different appetites coming into our sector and then influencing decisions about business models, your whole strategy, and you're needing to then understand that. It's not some great revelation about our industry. That is actually what happens in any market, in any sector, and it is called supply and demand, but I think we're in for a structural change. That's why I agree with John. Actually getting your costs down is going to be critical, because when you've got people coming into our sector to get investment out, but also the reinsurers knowing how they have to compete, then I think there's significant structural change. And if we lock ourselves talking about the sector being in a cycle, we're just waiting for it to change, and it won't.
No.
And I think that's where it's very dangerous at the moment.
Yeah, I quite agree. Yeah. Look, I think it is absolutely structural. I mean, the figures that were quoted in Munich at 25%, or whether that's right or not, but that's what's happening. The markets are evolving, and capital is more portable than it's been before. Regulation is manageable in terms of capital coming and going, and so people are looking to deploy their capital around the world more efficiently. Whether that's going to be long-term or not, time will tell. But and it's not just about the capital, it's about the distribution as well. You look at the way that insurance brokers are trying to take more and more of the value chain now, by doing underwriting, by buying underwriting agencies, by pushing into the space that was historically the province of intermediated insurers. And again, I said it in forums before, the parties that are at risk in the current environment are intermediated insurers if they cannot show that they add value, just as insurance brokers are at risk if they try to extract too much value from the insurance dollar. Because as transparency increases and market dynamics increase, then you're going to see that people are going to have to add the value that they extract in terms of the cost to take out.
Probably 2 points for the consumer there. I don't know if this mic's still working. Is good. The one is it's a big protection issue, reinsurance, to make sure that our customers are properly protected. So the alternative sources of capital just need to be of a good quality. And I had a good conversation with Bob about it, and I think those instruments fundamentally work, and they can also drive pricing points, which essentially give back value to the consumer in lower costs, as the guys have explained. So I think there's a place in the market for both. We should look at them, but just cautiously at the start, I suppose.
Just in terms of what Bob was talking about before, one of the things that came up for me towards the end of his presentation was the recommendations about how important it is to get the basics right. So if you looked at what his presentation talked about, it was about managing the underwriting process appropriately, managing expenses more effectively. So I thought that was a really good lesson for all of us, that actually, whilst technology is changing, capital sources are changing, the fundamentals of what we do don't change, and we should never lose sight of the basics. And the only other point I wanted to make was just in terms of digital technology completely changing the playing field. As a direct insurer, we can see now other players coming in and using digital technology in a distribution sense to compete against the traditional direct players. So for us, we have to broaden our horizons and think about using digital technology, much like John said, to actually strip cost out of what we do so that we can more effectively compete.
That's a really good lead into a question that was in the back of my mind, which is taking Jackie's point, and everyone's point about stripping costs out in terms of the whole value chain. We've got data which is as cheap as chips, and the Internet of Things is just exponentially rising, so that data cost is next to zero. The capacity for, so the question really is, a disruptor like a Google coming in to the industry, is that, you think that's a real threat, a real risk? Does it keep you up at night, or are there other more pressing things?
I'm on a board of a credit union in Australia, as a few people in the audience know, and one of the things that we watch is the payment system and how payment systems are shifting dramatically through some non-traditional players. I think it's Apple that's just partnered with Amex to offer product in Australia at the moment, which is actually going to change the game on a few things and how it's paying out. And so I think for us, we have to assume that things will change. But whenever I've been to Silicon Valley, one of the things they talk about is when you've got bureaucratic, old-state industries, they're easy to disrupt unless they're over-regulated. And I think that's the challenge that the country has here, that we have to get that balance. And I think David brought that out really well about how do you get the balance that regulation doesn't overdo it, so you stop some innovation that can help the customer. And I don't think it's just about whether it's a Google or an Apple that could come and disrupt you. And in fact, I know for a fact those two organisations are worried about where their growth's coming from, because they're seen as incumbent organisations now and other people are chipping away at them. I think our big challenge is how do we not get locked in to thinking regulation will protect us from disruption and continue to challenge ourselves about how we can disrupt for the benefit of the customer and not just be focused about will they come, will they not come. It's about really thinking about the disruption we can be doing ourselves.
Any others want to jump in on that one or not? No. Another issue that comes out of the data capacity and analytics is that whole ethical question around whether someone is now identifiably uninsurable and I guess just opens the opportunity where you get a dynamic around cherry picking a market, and what are the flow-on effects for the consumer base as a whole as a result of that. So, you know, your thoughts on that as we sort of, as more and more data, more and more risk gets identifiable to that extent. Chris, any?
Yeah, I just think it's, you know, I always think about accessibility and affordability, and I think the more access we have and the more capability we have to analyse data, then the more sort of refined risk decisions and pricing decisions we can make. And I think if we get to the position where people end up not having access or can't afford to buy insurance, then we've got a problem. Because, I mean, we all listened this morning about, I think 98% of Cantabrians were insured. And so, you know, we've got an obligation to compete, and to do that, we need to use data more effectively and more effectively than competitors. But there is a danger long term, I think, that you end up with people who simply can't access or afford insurance. And I think that's a problem that we need to think about.
Other comments on this topic?
I think you know, I think sometimes the explosion of data is viewed as a bit of a problem, but it's also a bit of an opportunity. And I think one of the things about the data is that, and particularly when it's applied with technology like the pay-as-you-drive type technology, that what it can do is it can help to modify behaviours. And you know, you see that if somebody is got an app in their car that's telling them how they drive, and at the end of the month their premium goes up because of the fact that they were speeding in the last month, then that's a good incentive for them to actually modify their behaviours. And I think there's some really positive aspects that come out of it. There will be ethical questions, as much in the life insurance, probably more so in the life space than in the fire and general space, with DNA and genetic testing and all of that. But you know, we'll deal with those issues as they come up. But I think the opportunities are incredibly exciting. I don't think there are threats out there, business threats, insurance threats, but ultimately it's a fascinatingly exciting environment coming up.
I think it goes back to challenging us on our original thinking of how insurance established about community rating, which actually said that even if you could have all the data, you would actually, for the common good, community rate, and whether you're a health insurer, whether you're a life insurer, or whether you're a general insurer. And I think our dilemma is that consumers and any customer we crowdsourced the buzz, so we got quite close, and we didn't have a brand, so no one knew who we were. And when you talk to people who feel they're a good risk, they do not want to be cross-subsidising people who they perceive is a bad risk. And they are happy to give you all their data to prove that they're a good risk. If you're someone that's not a good risk, or unfortunately live in an area, and I cut my teeth on insurance in Australia, so far North Queensland was the example there, but nearly ended up in the problem with Christchurch, and government was very responsible with the red zone. And I know some of my colleagues on the panel spent a lot of hours and long time with government as we work through that. I think the challenge we've got is the consumer sentiment about who wants to share their data with us and who doesn't, because it goes to the heart of that community rating issue and who's benefiting and who's not. And that's a really difficult issue that we're going to have to continue to face and be challenged on, I think.
I think you touched on an important point, Jackie, in the sense that, you know, with data in the telematics sense as an example, there's a real opportunity, and people who perceive themselves as good risk will likely back themselves and say, yep, I'll give you my data because I believe in myself. I don't want to cross-subsidize someone else. I think it is a more complex conversation in property insurance due to, you know, building codes, where they're built. Protection is probably more important there than just the use of data. You know, for us as a new insurer, clearly it's a risk appetite thing, and you've got to approach that carefully, but there's good data to help make those decisions. So I think, you know, over time it's going to become even more and you know, a bigger feature of what we do.
Yeah, and I sit here with
Tim, the one thing I would add that's different about data is probably 10 years ago, it would have been harder to be a new entrant into any market because the data that you had access to was more proprietary. With so many data points out there now that you can actually get, and I mean, we challenge ourselves as IAG saying our data is our competitive advantage, because it's not really. because you can get so many data points at Christchurch. I think it's the only city in the world that every single section has been mapped, and anyone can get that. So us having been involved in the rebuild in Christchurch, knowing the land doesn't give us a competitive advantage because you can go online and get it. And that's a big difference too.
The insurance claims register is probably another good example. So.
I sit here with a Fitbit on, and there's probably quite a few people in the room that do the same. So, instantaneously, someone somewhere has the capacity to know my heartbeat, where I go, what I do, the risks.
That's why I didn't put the Fitbit on.
And that can be linked up to, purchases you make and all of that sort of stuff there. So, the capacity there to come in with, rather than an all risks, health, life, general cover. Do you see that as a potential evolution, or do you really think that we'll keep our separate lines, so to speak, as we go forward?
I think someone raised this morning, one of the speakers talked about insuring, particularly with the sharing economy, do you then need to start thinking about the person rather than an asset? And I think the reason that our sectors have always been evolving the way they are is because we thought in an asset-based way. And if that breaks down, then that becomes less of an artificial barrier between classes, albeit often it's driven by the supply chain too. So coming from a health background, the supply chain of health insurance is very different to property insurance. So I don't know. I mean, what's your thoughts?
I think there's interesting angles in there, and I think it may come to that, and logically, from a consumer point of view and everything, you start with the consumer, they don't think about insurance as being ACC, EQC, fire in general, life, health. They think about insurance as insurance. It's all insurance to them. It just happens there are at least 5 different categories of it in the New Zealand environment. I think what's likely to happen is that insurance will ultimately merge in with maintenance contracts, say on property, particularly as we get to that sort of sci-fi level of sensors all over the place, that you will be able to predict when things are about to go wrong, and you'll fix them before it happens. So there'll be that sort of integrated insurance with a proposition somewhere else. There'll be bundling, and bundling of insurance is an interesting angle in terms of, you bundle your Wi-Fi with your electricity now, with your phone service. So, where's the point at which insurance can be bundled? You look at the car manufacturers, they sell a new car with 3 years servicing. Well, why not sell a car with 3 years insurance included in there? You can do that if you can get the data to give you the right pricing mechanisms to give you some ideas of what's going on there.
Does that suggest diversification for the industry into other areas, or partnerships with providers of those services, so it becomes, a richer engagement with the insurer because of all these add-ons? I don't know.
Yeah, I think the traditional way of looking at insurance, which is about the things that people own, so the assets that they want to protect. We heard some stories about driverless cars, and what does that mean for the car insurance industry and all that sort of thing. And we hear about people who won't be getting driver's licenses. People live in cities and they won't drive cars, and they'll probably call up a driverless car and they'll use that car for a period of time to take them somewhere. And so I think for me it's more turning our attention to what consumers really think about insurance, and I think it's more about getting some help to manage risk in an uncertain world. So if we think about that, then we'll probably be looking at people and their experiences. So how do we support people's experiences and the risk that goes alongside those experiences? So, it's hard to sort of predict exactly what that might look like, but a package of things that protect an individual from the risk of uncertainty and disaster, you can bundle that up in all sorts of ways. So that's kind of the way that I'm thinking about this.
Yeah. Go on, Tony.
It's a fascinating proposition. I think there's a real opportunity. Whether it's health data or property data or driving data, the fact is it speaks a bit to the consumer's awareness of managing his personal risk, whether it's asset risk or health risk. And in the South African market, as an example, we have a fully underwritten life insurance business, and we also have a motor insurance and a property business. And there's a strong correlation between those data points from a risk determination point of view. So whether you could completely bundle it, I'm not sure. Whether customers would be willing to provide you with all that data. I mean, you then really have, there's a lot that goes with that, but it's a real proposition, I think.
And Tim, you mentioned about partnerships. I've watched with interest as I've been tracking my emails today about when I met with Uber over in San Francisco, they were talking about their biggest challenges coming into new markets is about the mindset of the incumbents trying to lock people out. And so they've had to be quite creative thinking about how they demonstrate that their reputation is good and that they do have a reliable business model. And I noticed on my email today they're doing a spring clean support and partnering with the Red Cross that on Sunday you can call an Uber driver for free and they'll come and collect any clothes that you want to donate. And now as an industry we have to think about, we'll talk about risk and we'll talk about safety and we'll talk about the things we know, but it's going to be these intersection of partnerships, because I think it's very clever of Uber because they're giving the time, but they're linking it with something people are probably doing about sorting out their clothes. And I think in the US they did kittens, and in Australia aren't they delivering ice cream or something to show how they can get things to you quickly. But we get trapped in thinking about our models and our sectors, and if we're really thinking and hearing the customer, our alliances will form in my view, very differently in the next 10 years than the traditional alliances we're used to.
I think partnering is one of the core competencies that's going to be absolutely essential, because the pace of change is so great that you can't invent it all yourself. You've got to partner with third parties who are inventing it, whether it's telematics or data or whatever, or distribution. Partnering is an absolutely key capability, and organizations that partner effectively will be the ones that will succeed.
We've got a couple of questions here I'm going to come to in a moment. Anybody else who's got questions, fire them through, but we just, the flow's gone quite well at the moment, and but I will get to them if people are waiting for that question to be asked. Just a quick flip onto the cyber. I was quite stunned by the figures I think that Alan put up. Was at 2% fire risk, 73% cyber hacking risk. That just seems, when we look at the sort of emerging risks and opportunities for growth, if people are saying that motor premium might be affected by the longer term technological changes occurring, but why is it that we're not on? I know it's an emerging risk, so it's early days, but what have we got to do there? Because this is a nation built on small businesses for whom cyber risk is something that I just don't think they're turned on to at all.
Oh, I think about what the government have alerted through as well in terms of protecting systemic risk of industry. So, for example, the banks and Fonterra and what they're doing with security there, it's probably going to be like anything else, that we have to look at who's working on the risk mitigation, and as an industry, how are we partnering on the risk mitigation. The issue of cyber, I think, is quite complex, because you've either got the issues that happened in terms of just human error and data leaks out and then is misused in some way, versus, I think someone said, the criminals getting into your data. And, what will blow up the trust of our industry is if we don't protect that data, but then we also have to, as you're saying, protect customers that might be SMEs or might be big businesses. And the point was made today, there's not a lot of data points to price on it, and I think that's probably where we're all at. How do we understand what the risk is and how you price for it? But we could be doing some preliminary work and understanding what's being put in place for mitigation, given New Zealand, we're a pretty isolated country with one pipe coming in. So how do we have to think about it from a risk management point in?
Look, I think it's like anything that comes along, whether it's Y2K or the pandemics or whatever. We can either, as an industry, seek to provide products that are useful for consumers, we can try to frighten consumers into buying stuff that they don't need, or we can actually batten down the hatches and not give any cover because we don't understand it. And I think it's, as Jackie says, if the data points aren't there, you then need to wait until such time as you can price effectively and actually deliver real value. But I don't think it's anything different from the stuff that we've dealt with before. It's other than the fact that the pace of change is perhaps a little bit faster.
Okay, I'll go to a couple of questions here, but a final question, and you can just think about it. It's a little bit of crystal ball gazing out for the next 10 to 15 years in terms of what the insurance industry and the consumer will look like in that time. So we'll come back to that in probably the last couple of minutes or so. But so here's a question from somebody who is challenging us. How can insurers argue it's about value, not about price, when the public is being told through 70% of the industry's television advertising, promoting discounts and how to get cheaper insurance?
I think that's a very good question, and that's what I think we have to ask ourselves as an industry is how are we signatures to the UN saying we want to signal it's about risk, and then we behave, as soon as the competition comes on, we revert back to a pretty low denominator instead of thinking about and that's tends to what, and we complain about we become a commodity and then we behave like a commodity. And so I think that's a very insightful question, and I'm not sure I have the answer, and it's a frustration, I think.
You look like
Just an observation is that I think you can generalize around insurance, and I think you have to look at different segments in isolation. So private motor insurance to a large extent is commoditized. Corporate property insurance is not. And so whilst you've got price pressures in many different segments, the dynamics around selling and risk are quite different. So the risk of somebody with buying a cheap motor insurance might be that they don't get the repair they want, but it's not necessarily going to be a major issue. If it's insuring their house, that could be problematic if they've got the wrong type of sum insured or don't insure it adequately. So I think you've always got to put it in the context of what's the risk to the society and the consumer.
I think it is a good question, but price is clearly part of the value proposition. There aren't two standalone pieces. Price, product, service, and trust essentially is what we as an insurance industry present to customers. But price is part of that equation, in my view.
Yeah, I think it's an interesting and very challenging question, but I'm not sure I agree because I don't believe that necessarily this industry, the players in this industry, do focus on price. I think some of them focus on price in return for something, which is additional value. So, I think I'd be horrified if I thought that we were very, very retail across the board all of the time around price. I think we use marketing executions that are quite retail focused, which has a price element to it. But I don't think we've got to the point where we're really advertising just price, would be my comment. Good question, though.
Someone else has come up with I'm conscious of time, so we'll be wrapping it up very quickly, but another sort of challenging question here. Whether New Zealand doesn't develop its managerial talent sufficiently well, because not a single person on this panel is a New Zealander.
I'm a New Zealander.
And it makes for rugby very interesting times.
Can I just ask a question? If I've been here for 20 years, does that classify me as a New Zealander?
I'm going to ask the Australian government about a New Zealand.
You can ask me who I supported the rugby.
Chris,
Yeah,
you
JP.
and I have
Last
been
week.
in the country longer than some people in the room.
Yeah,
who are quite
I
young.
think that's right.
And very finally, any thoughts on that sort of longer term view of what the insurance industry and the customer is going to look like in 10, 15 years' time? Or
Yeah, I mean, I'd live in hope that, one, we have much more diverse workforces that reflect our customer base and in our ranks. And obviously, being a female leader, I often get asked to speak on diversity, and I think counting the girls, I've said it before on podiums, counting the girls in the room is not being called a diverse organisation. It's about how are you actually using your talent to reflect your customer base and get diversity of thought. And I would hope that we have diverse enough organisations in experience thinking gender, ethnicity that do reflect our customer base so we can be more innovative and continue to change. I think it's a bit hard to say what would we look like in 15 years. We should keep evolving, but we can only do that if we actually manage our talent to actually be inclusive and not be, we used to call the Knowles Boys Club, but I think it's just as dangerous if, as girls, we're in the industry for a while and we lock out other industries. So that's what I'd be hoping for the future, so that we can keep evolving and adapting for what the customers need.
Any quick comments before we just close off, because I'm conscious of
Other
time.
than just it's futile trying to predict what the future will look like, because we know we're going to be wrong. All we can do is try and assess what are the major trends and adapt to them as quickly as we can as they evolve.
Okay, look, I just would like to ask you to recognise the time given by the chief executives on the panel here, which has been, I think, a very interesting discussion over the last 45 minutes or so.